Good day, everybody. Brian here from quantlabsnet.com. In this video, I'm going to talk about position sizing of options, futures in a interactive broker's account. I would assume it's pretty well the same in any brokerage. That's all regulated by the CME anyways. So let me just show you what we've got here. So first of all, we're looking at my Quant Leap programming custom files. So if you're interested in this program membership, let me know. Get in touch with me. Here, I've just put up this specifically for interactive brokers with the TWS. This is the account size for interactive brokers trading. So in here, let me just run it for you. So I'm going to get right into it and just give you some example code here. When you uncompress it or unzip it or un-RAR it, it is got these files in here. I put in some documents here. So the main program is this. So this has basically been converted over. I have a C++ equivalent as well. This one as well that I put up a few days ago. So I've converted that code into the Python and I've added some new features. These features include now um, calculate margin requirements, capital requirement summary, position sizing analysis, and general margin uh, account. So there's going to be a variety of trading strategy types we have added to this particular portfolio that was generated 2 days ago. And it's a lot more than I thought. These are with micros. So trading options futures can be a lengthy thing, but I'll show you later on what this particular strategy looks like and why I do this process. So again, all this is generated via um, uh, via uh, via AI. Okay, so here is what we're going to be trading: ES, uh, CL, ZC, and CC. Okay, so these are the temporary allocations you could have at, let's say, $50,000. These are expected P&L based upon certain trading types. Okay, so each one's different. That's why I've added these new functionality just to give an idea of how much it will cost at a minimum in the micro space. So if you choose, let's say, all of the available, and there's a lot of other ones as well for micros. So here, with the amount needed for these type of trades, so let's say you want to trade the micro, or sorry, the E-mini, micro E-mini S&P margin requirement for 5 contracts for this particular instrument is 1320, and you need 5 contracts to just trade that. With the E-mini NASDAQ, 1650, 2 contracts. E-mini Dow, 825, half a contract, and so on and so forth. You can clearly see the popular ones are going to be more expensive for the margin requirement. Gold, silver, Bitcoin is really excessive, I think, but it doesn't mean that they're naturally like the best strategies or assets to hold. So these are the total contracts size and the margin requirement. Okay. So in that, when you look at further the capital margin requirement, these are the capital uh, needed um, required at 8294, recommended capital half a 50% budget, or a conservative at 22,000. Option premium required at $29, which is very low. And then there's these different types of accounts as well. So apparently it's 110,000, so it's big boy stuff. Okay, so if we continue into the position sizing, so let's say we want to do 50,000 on this particular portfolio, which I'll go into detail in a minute. You have 50,000, and here's the allocated recommended based upon outlook of forward guidance and backtest the history to get as best as it can calculate the um, optimal uh, forecasted amount. So here for ES, you would need 60 contracts at 30,000, CL at three contracts at 30,000, and then the ZC one contract and ZC for CC as well. So with these calculators I can generate, this is just one example that I'll now move forward to see what's the best. But if I go back into capital requirement, if I put in 5,000, okay, oops, no, let me do that again. Capital requirement summary. Uh, nope. Okay, so let's say we do position sizing at, let's say we do $5,000, just total amount. It should come back and say insufficient capital, position reduction required. So available capital. So in order to do the basic minimum, capital requirement needs $16,500 with a scaling factor of 30,000. Okay. So here it allocates the original, the adjusted, and the contract sizes as well. So that's a good thing that this will run. Again, this is all done in Python generated by AI. So let's generate the required margin report. So these are the, again, micro contract specs. This is always changing. So as of this time, will be all these, and I think I've gone through these with the micro e-mini contract sizes. Okay. So this is really a good little calculator. So let me show you now uh, the available. So you can see here it's got functionality that will connect into the interactive brokers um, connection status. So let me just break this. Okay, so in here, if you download this package and you're a member, we have here this original report, and this is the executive summary that I've talked about in the past. So I put this here for reference, and this is what it suggests. So this was generated 2 days ago on the 13th and 14th of August, like yesterday, pretty well. So in here we've got bullish on corn via a long future, okay? And here's the amount, the targets available for the next 4 weeks. There's now trying to exploit volatility in the crude oil with a long strategy, gives you all the detail here, with all the stop losses, take profit targets over a 4 week period. Strategy three, a high conviction basis trade on cocoa. Okay, and I'll show you all that. And it gives you the targets here as well as a defined bullish stance on E-mini. Okay, so the E-mini S&P as well. Okay, so here it gives you the optimized allocation if you had $50,000. As I said before, we noticed that we can need to deploy 16,000 to deploy that strategy. Out of that, we're going to allocate 10% or 5,000 of it for cash. Okay. So as I said before, the bigger your portfolio that you're willing to risk, the more options you'll have. Okay. So let's go through the Streamlit app that I've shown before as well. Um, so is this one right here, the app Python. Okay. And here, uh, it's going to load it up. And this is where a lot of the research comes in. So let's say you go, I don't have 50,000, I don't have 60,000. So what you can do with this type of research is to be able to say, okay, I'm going to pretend to have I have 50,000. Okay, here we're going to try to overall get $1,900 out of that over the next 4 weeks. We have a portfolio projection at 17.8%. So that's pretty high. This is now hallucinating, of course, part of AI that you can ignore. Here's the different uh, strategy types that you can apply. So we have a basis trade, a bull spread, long future, long straddle. So if you're confused about that, I do have a course now that I've been running now for months, really, on how to learn all this stuff because this is where the money's going to be made to handle volatility, to project the volatility as examples, to project what will move when the markets and the equity markets go down. And let's face it, crypto's kind of dodgy to trade because of the extreme volatility, just as options for you. So here we have a value forecast over the next 6 weeks. So we anticipate a 49,000 and have 52K at the end of it. Okay. So that's the overall portfolio as is right now. So here with our strategy analysis, now again, I can generate this. What I can do is I can figure out, well, what are my particular instruments that are going to give me the most amount of return. So over the next 4 weeks, in this case, we have here corn. Okay. So we have week 1, week 2, week 4. This is the profit. So that looks pretty good. So over the whole process, we're going to make a bit of money. So here, we can calculate, we're only going to make $5 in week 2, $5 in week 3, and maybe $4 in week 4. So the question becomes, well, you're going to make the most amount in week 1. Okay. So if you knew how it works with the course, is that you learn about uh, capital, uh, um, capital against opportunity costs. So these three right here, the last 3 weeks are an opportunity cost because you're going to earn capital at very low returns. So what's the point of having that? You're better off to deploy your capital here for the first week to get this max profit and free up your capital later on. So my whole view of this is changing over time. And again, you can readjust and generate new scripts and programs to adjust the automated trading as time passes. But overall, this is a good one because the volatility is really low. Anything under 20% is good. Preferably, if you can get it under 15, that's better. And then the Sharpe ratio is no good. Okay, so our expected returns about 10% if we allocate as is, if we were going to do that $50,000 allocation. So now let's take a look at crude oil. So if we allocate a 10K volatility at 23, that's pretty high. Current price, expected return, 7.4% over the next 4 weeks. Now, this is an analysis on an individual instrument, okay, using this particular strategy that would be applied um, to oil or CL. So this is basically a specific strategy designed for volatility because oil has gone volatile. So here's the price forecast in blue. And if you were just to trade, uh, well, trade with everything in the cumulative P&L, you're better off to just maybe focus on oil because you got an extra boost tying up less capital on other instruments that are kind of dogs. This is the whole point of this exercise and this particular Streamlit app to analyze this. Okay. So the other question is, are you wanting to take on 23% volatility with a 7.4% return, or are you willing to take on a trade that's going to generate only 14% volatility and a much higher return over the 4 weeks? So you kind of get the analysis that a lot of portfolio managers will look at. That's why they're paid the most in any type of investing or trading out there, hedge funds and whatnot. This is what they do. So you know right now you might not want to tie up any capital in oil because you have a lower volatility forecast and a higher return. So it wouldn't make sense to take on that trade with oil. So also with cocoa, same thing. It's a basis trade now. We have a cash price, volatility a little higher, 18.4, but you're going to lose money. So right out of the gate, I'm going to take that out. Okay. You don't want to lose money on that trade. Okay. That's forecasted. So we'll take that out. So boom, it's gone. So now we have left out of that we haven't seen is the ES or E-mini S&P 500. So here you have current price, volatility, which is fairly low, and only 1.2% return on that. So here's what it looks like. Is it worth tying up capital for that? Probably not. So now you're left with two trades, okay? between oil and cash. Okay, so what you've done there is you've gotten rid of the potential money loser that will pull down your overall uh, pull down your overall um, portfolio that you could have traded with, but knowing what you just know, you got rid of that asset for both oil. I believe it's what we got left here is crude oil and corn futures. Okay, so we know what kind of trade analysis we want. So knowing that, we can go back and start using these tools that I've shown you in Python. Again, you get the source code when you join to be able to do this and be able to do this on demand on any best looking best looking instrument in the futures market. So when you look at the back testing of this, okay, so we have left crude and futures. When it comes to back testing now with AI, I see no point in blowing our brains out trying to figure out how to calculate back testing. Just does not make sense to me. So if we already know we're going to get rid of the cocoa, let's get rid of that. And we're also going to get rid of the E-minis. So now we can see over the last 30 days how these assets have performed. Just these two here, which are left is corn future and crude oil. You have to remember, we're now in mid-April, so it makes sense for corn to go up because we're in harvest season. We're about to go into it. So that would make sense where you profit. Okay, so here, this is the nice thing about it is that it will take a look at your drawdown analysis. And this is also critical on your risk analysis, on your risk management. Again, this can only be looked at by AI and the type of AI that I use, which are pretty well the most advanced that I've talked about. You know that the drawdown is kind of excessive, but what's a probability? So we're looking at an average potential drawdown of negative 2% on corn and oil at 7%, which is fairly uh, decent. And when you look at the current drawdown, it's only at not even 2% for either. So that's fairly low risk. And when people come to me now with analysis questions on their strategy or their instruments, this is what I tell them. You have to look for things and forecast out using back testing. Obviously, again, use the AI to generate that and generate these charts, and specifically to generate these particular type of apps like in Streamlit, because Streamlit's great at this, is that you want to look at that's going to give you lowest um, forecasted uh, drawdown and the lowest volatility as well. Okay, and that's also including specifically um, crypto, because crypto volatility is so extreme. Doesn't mean I don't like crypto. Just that's just the way it is when you're trading these type of um, instruments. Okay, so here you've got how's the overall strategy been using these suggested by AI strategies. So you can see here combined, we're doing pretty good. So over the last 30 days, we're at 5.21% uh, over the last 30 days. Plus, we have a 53% win ratio, which is really good. And that's measuring at total trades of 502 with a mediocre Sharp. But I'll gladly take a 5.2% win ratio at 53% combined with this, regardless over the last 30 days. Now, if I measure it over the last 90 days, what's our calculation being? I'm not sure if that's getting updated. I'm not sure on that. Let me just see. Year to date. Okay, let me just see. I am going to do this, the refresh. Okay, I'm not sure if this is working as I want, but that's okay. The 30 days good enough. Yeah, so I could easily adjust this. But still, those are pretty good win ratio. I could update the AI and put a request in to update this if I wanted, but as is, I'll take it as it is. So that's pretty good considering where we're at on a back tested. I'm going to assume as is, that's across the whole portfolio. So our risk management now, um, so this is again with everything. Okay. So, so here we have volatility by instrument. Oil's the highest. Corn is fairly low. Maximum drawdown is cocoa. So you don't want that in your portfolio at all. Too too high risk. Now, again, these are the different types of strategies that you could use. So I've already gone through the amount of contracts needed for the strategies that are suggested, but yet you can see the overall current P&L forecasted for bull market, for base case, for mild correction. That's the other good thing I like about this particular AI that I use. It gives you an analysis on if you have extreme cases, if it's black swan, um, like a market crash, and what would your percent be? So with different scenarios, even on a market crash, you'd still may be able to eke out a 6.7 return on the current whole portfolio. That's really good. In fact, this is one of the reasons why you want to trade futures and options, because it reduces your risk of losing money, okay, with the combined type of strategies for the combined types of instruments at that time when you back test them. But our best case scenario on a bull market, if the bull market continues the way it's going, we could earn 16.2%, and that the lowest we'll make is 6.7%. That's really good to have. Okay, so there's different strategies that you can figure out. And don't forget, when you join my elite, you're going to get the source code to adjust the AI what you want. That's why I'm heavily been focusing on this for the last number of months to get into the mindset of a institutional level um, portfolio managers who I might remind you in large banks and are the top kahunas in the space of investing. Portfolio managers get paid the highest possible, quant or not. They will be paid the highest, and I keep saying the highest paid in Goldman Sachs on average in London's 9.2 million pounds. Okay, so that's crazy. When you do this kind of analysis and get your mind into this, this is why you get paid the most. Because now you know what to trade. And with AI now, you can purposely trade those combinations with those particular strategies over the next week, over the next 30 days to be able to get maximum return at the lowest risk via lowest volatility and lowest drawdown forecasting. This could never be done back in the day. So here we are got a risk tolerance we can set, and you can just click on an optimized portfolio. We want maximum return. So here we go. This is the forecasted amount as is. So if we rebalance and have our script do that, you can see already we would lose money on both oil and cocoa, and we would gain only on corn futures and E-mini S&P. Powerful things to know based upon data in the past we used to forecast and to generate to generate to generate the forecast, and we also have our efficiency frontier. And again, that is forecasted. And I got to keep mentioning this whole simulation, this dashboard you're looking at is for informational purposes only. It's research, it's not financial advice. But you can suss out your own determination on these methodologies. These are so powerful. No, I can guarantee you, no portfolio manager, even that manages well into the hundreds of $1 million, do not do this. The funds that trade their own money, that trade in the billions, do this for sure, each and every trading desk. So here we're going to calculate if we just uh, did our biweekly rebalancing, right? You can still see um, everything's looking good. So these are the best potential instruments to trade for the next 40. And that's out of the 40 plus available instruments through the CME, these four particular ones. And we drilled it right down to both corn futures and E-mini. Okay. And here's our individual instruments as well with the allocated amount as well. It just goes on and on and on. So the point here is for a lot of reasons, and people that end up watching my complete videos do well. Those who just kind of like doom scroll and just kind of go, it's no good. I can't learn from this, or you're not putting out stuff. And people are actually trying to learn from my media clips or my shorts. It's mind boggling. they lose, and they lose bad, and they lose a lot of money because, and they're probably unemployed, can't find a job because the AI that they were working on totally replaced them, not just their job, but their career. So if they don't put the patience in to learn this stuff, they will lose and eventually get wiped out. Like people are sending me the horror stories that they're having just to survive. It's sad. But if you're going to do the trading as a business, this is what you got to do. This is what you got to learn to trade like a multi-million paid portfolio manager in large funds that do this day in and day out to look at risk and to look at what's good. And the best part is to be able to take the AI to get you to this point to learn and research it, develop these kind of tools, again, all in Python. At the same time, you can use the AI to deploy these strategies against a live portfolio in interactive brokers, as an example, be able to trade it with, again, with Python. And as I've shown before, you can now do it with C++. So if you want to enter in this career, this is what you do. This is what you learn. This is what you watch. And that's about it. That's all I can tell you. If you want to know more, if you want to know more, come to my Learn tab at quantlabsnet.com. Get yourself a C++ HFT ebook, or you can also learn the same thing off my main page as well. I don't release any of the information you submit. It stays with me, and that's it. I don't resell this stuff. Anyways, hopefully I'll help you out, and have a good day.